听见资本本期视频为您带来的是摩根大通在3月21日关于新兴市场固定收益领域的观点。他们聊到了新兴市场央行如何在全球不确定性中艰难抉择，一边是美联储的政策转向，一边是关税威胁带来的通胀压力。有的央行选择踩刹车加息应对，有的却还在小心翼翼地降息刺激增长，这其中的平衡数可不简单。接着我们聚焦土耳其、印尼和阿根廷最近的动荡，国内政策和政治风波让这些市场频频登上头条。这些是独立事件还是隐藏着更深的系统性风险？两位专家剖析了这些突发事件背后的真相，看他们究竟是昙花一现还是会引发更大的连锁反应。最后我们放眼全球市场，标普500下挫，波动率飙升，高收益债券利差扩大，风险情绪正变得紧张。这对新兴市场意味着什么？投资者是该谨慎观望，还是能在乱局中找到机会？接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello, and welcome to our At Any Rate Emerging Markets Focus podcast, the place for us to discuss recent developments and key issues of focus in the emerging market fixed income asset class. I'm Johnny Goulden, Head of EM Fixed Income Strategy here at JP Morgan, and I'm joined by Saad Siddiqui, Head of EM Local Market Strategy at JP Morgan as well. Saad, thanks for joining.
Hi, good to be here.
So there is a quote attributed to the British Prime Minister, Harold Macmillan, who was asked about the greatest challenge for a statesperson, and he reputedly answered, "Events, dear boy, events." And this week feels like one where that is a reminder that it is often true for emerging markets investing. We thought that this week we'd come in with the Fed and other EM central banks and be focusing a bit on the monetary policy cycles and that central bank calendar, but instead we have been dominated with headlines and price action in places like Turkey and Indonesia and Argentina, for example, which are more domestically focused. So in this podcast, we will try and discuss a bit about EM rates markets and monetary policy, but we'll also have to deal with the events and the range of these domestic political developments and if there are any wider implications for emerging markets overall. So, Saad, let's start with the firm ground then and talk about EM rates and monetary policy cycles. Do you think that EM central banks face pressure to pivot away from easing biases and start to look at the inflation potential and uncertainty from tariffs, or do you think they'll be focusing more on the growth outlook and potential growth hit which come from that uncertainty as well?
So I'm going to give you the most unsatisfactory of all answers, which is it depends. And that's not a way to kind of hedge the answer or a cop out. But I think what's been happening in the last few months is that, second half of last year, it seemed like it was pretty plain sailing towards rate cutting cycles. The Fed was cutting rates, EM central banks were cutting interest rates, and broadly speaking, emerging markets from a starting point that for a lot of them was with high real interest rates, high nominal rates, were also cutting interest rates. The disinflationary forces through 2024 were aiding that process. I think something changed in December when we had that Fed meeting, which indicated the Fed is not in a hurry to cut rates and that they are on a pause. So I think that was the first challenge and the first hurdle that central banks faced. And since then, I think what's been happening is while the underlying bias or tendency to cut rates, I think is still there, it's this combination of the disinflation process, which is now stalling. So we're no longer seeing, broadly speaking, downside surprises to inflation. A lot of emerging markets still have inflation above targets, and it's not falling. And then you've got the risks of what tariffs might mean. What do tariffs mean? There's potentially higher global goods inflation, for example, and that's going to make life a bit more difficult for EM central banks. And then at the same time, you have these large tail risks, these left side tail risks of potential U.S. growth slowdown, and even talk about a U.S. recession, something that we discussed last week. So I think that puts emerging market central banks in a difficult position. If you look at our economists' Hawk-Dove score, which looks at central bank communication and gives that a quantitative numerical score regarding how dovish or hawkish they are, we've basically seen that that score has been stable at both the broad EM and the DM level for the last 2 or 3 months. There is a divergence between Asia and the other markets. I think in EM Asia, I think the central banks are much more focused on potential downside risks that could emanate from trade policy, from tariffs, and the downside pressures to growth there. And I think the other central banks really are subject to what you said, to your intro, Johnny, which is they're subject to events. We're seeing hikes in Brazil. We saw interest rates being raised in Turkey as well this week. But there's other central banks like the Mexican central bank, which is still in a rate cutting cycle. So I think there is a big divergence there between who is directly faced with growth downsides and has the ability to act versus those central banks that don't quite have that ability to act right now.
So presumably markets haven't been standing still in terms of EM rates here as well. What has the market been pricing for EM central banks? And is there much more cutting that can be priced in here?
So we've seen the biggest variation in market pricing of central banks in Latin America, as you'd expect. So over the last month, both Chile and Mexico have seen the biggest shift, more towards a dovish bias in terms of market perceptions of where policy rates will be at the end of this year. And what they have in common is that their currencies are generally stable, and that allows these central banks to focus on the tail risks, the downsides to growth that might appear. And if U.S. rates are rallying and we're pricing in currently somewhere between 2 to 3 cuts in the U.S., that allows these central banks to also follow suit. For most of the others, you haven't seen large variations at the short end of yield curves. And actually, even though we've had a rally in short end U.S. rates over that period, some of these EMs have not been able to follow through because even the market's not sure. Is it growth or financial stability concerns that's going to dominate? On the other end, you've got, China local rates where previously there was a big divergence taking place between U.S. and China in terms of monetary policy, in terms of bond yields. And they've actually bounced a bit as growth expectations have increased there recently after recent government announcements and some better sentiment domestically. So if we're in a world now, Johnny, where there's tail risks clearly of slowing U.S. growth, of a recession, it seems like the base case is that rates are just going to be on hold, on pause for a little bit longer as central banks and markets digest the implications of trade policy and all these other factors driving currencies and inflation over the next few months. It seems that central banks and the Fed, for them, the optimal thing here to do is to sit on their hands, which means that rates could be higher for longer or at current levels for longer. And there's a risk in some markets, you might even see interest rates going up. How does that affect credit markets?
Yeah, so the first order impact is always going to be into EM rates and FX as part of that. But I think for EM credit, the channel, if this persists, is to slowly increase pressure on EM borrowers as financing costs increase. And then we end up looking back at what is essentially an ongoing background level of risk around this in credit markets, and that comes from the fact that if you look at both EM sovereigns and corporates over the next couple of years, you're going to see rising maturities coming due. So about 91 billion is going to come this year, 100 billion next year for sovereigns. Those numbers are sort of 270, 290 billion for corporates. So a decent rise, and this rise is going to keep going on, and for the next 2 or 3 years, this maturity wall is going to build up. So there is a need to refinance given the amount of borrowing that we have had. And as this happens, if rates remain high, then you see a general increase in debt service costs in emerging markets, in interest to revenue, and those things have persistently been going up. They paused a bit, but now with this rise in interest rates that we have seen since really the Fed started hiking in 2022, you start seeing interest costs go up again for emerging market countries. And the longer this goes on, this sort of high for longer, the worse that gets, because you're just refinancing at higher interest rates. And, some have talked about what's called the silent debt crisis in emerging markets here, where we sort of had a, very acute phase, around COVID, and then when the Fed started hiking, but actually what we're left with, if we are left with this higher or high for longer, then this becomes a chronic problem and it won't go away. It's there in the background. It sort of gives us some underlying vulnerabilities, which we'll still be dealing with. So certainly, if that's the environment we're going to be in, it does have an impact, slowly in the background, but increasingly in EM credit markets as well. So we've managed so far to avoid discussing the headlines, but we do need to come on to that now. And obviously this week we have had volatility in Turkish markets, weakness there. Indonesian stock market had jitters this week. Argentina local, a few others have sort of been in the headlines and continue to be. So I guess a question is for those looking from the outside or even from the inside is there something systemic going on here in emerging markets, and particularly in these high yielding sort of some frontier type of trades in emerging markets, which is going to be a bit more of a systemic problem for us?
So there always seems to be this coincidence, this cosmic coincidence that you get this barrage of events generally adverse in nature when global risk sentiment is also sour, like we're seeing right now. This is something we discussed a few weeks ago about equity market sentiment in the US and how that translates into an impact on emerging market assets. And we said at the time that emerging markets so far had been underreacting to the risk off that we'd seen in U.S. equity markets and the drawdown there. So this week it seems that there's a bit of a catch up taking place, but the catalysts driving some of this risk off this week in the markets that you mentioned, whether it's a Turkey or whether it's in Indonesia, seem to be non-economic in nature. There seem to be policy driven, it's political driven. So if I just think about it in terms of bottom up, I don't see much of a systemic or fundamental correlation between these markets. It's not the same as, for example, when you have a period where global capital flows are subsiding and there's acute macro pressures in some of these markets, and then those acute pressures begin to manifest themselves in kind of a domino effect across vulnerable markets. I don't see it from that lens, but I think most investors, market observers, participants looking at this either from the outside or from the inside cannot help but notice that it is happening at a time when overall risk sentiment is not in a great shape. So to give you another unsatisfactory answer about whether this is is it truly idiosyncratic or is this systemic? I would say that the common thread is that when you have bad or poor risk appetite, generally, investors are less likely to come in and fade these types of moves. So that's how you get the overshooting taking place. So even if it starts off as idiosyncratic, things can overshoot because of the risk environment we're in, and then you can get some second round effects. But generally speaking, I wouldn't look to connect the dots between some of these very specific special situations and say other more liquid EM markets. And I think in the last few months, we've seen other cases, when Brazil was having a period of market tumult in December, it did seem to be contained. So unless I think we get a real concerns about, say, a U.S. recession or a sharper slowdown, I think this will remain overall contained. You'll get a little bit of a spillover, but I don't see it as being a systemic event. So, Johnny, do you see it any differently? Do you think we should be trying to connect the dots and tying these together more closely, or do you think we should see them as independent events that just coincidentally seem to be happening this week?
Yeah, no, I think I agree largely with the way you put it. I think that what is common probably here is the market environment rather than the fundamental situation of these countries, which are all, like, if you try to draw something common between them, it would be very difficult to do that. But we are in an environment where in the last month, S&P had a 10% drawdown. It's not a common event. VIX had a 20-point increase. US high yield spreads were 80 basis points wider. It's a market which has a background degree of nervousness. And so I think in some of these situations, as you say, like, the market doesn't have a lot of risk appetite because they're looking at other bits of the portfolio. Or if you get a sell-off, then people are sort of saying, yeah, it's a sort of nervous global market environment. And I think for us, the way that we have tried to think about it in our overall allocations is to have a, sort of defensive stance on beta, and particularly in bits of the market like EM credit, where we felt spreads are just not high enough given that level of overall risk. But on these idiosyncratic situations, to sort of treat them as such, and where we see that there is decent amount of reward for the risk, and these ones always have risk, to sort of try and stick with them. So I think really that's where the commonality is, and until we get to something which is probably more end of cycle, I don't think there is at the moment something within emerging markets itself that is sort of flashing to us a common problem. And that brings us to the end of this JP Morgan at any rate emerging markets focused podcast. Thanks to you, Saad, for joining today, and thank you all for listening. We hope to have you back again with us for the next one. This communication is provided for information purposes only. Please refer to JP Morgan Research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on the 21st of March, 2025.